Hey everybody, this is Robert with the Money Coach Show and my colleague Damien joining me as we do each and every week to give market updates, mortgage 101 tips, as well as some guru tips. You know what? Uh, the aesthetically pleasing face on the show, Tara, she is out today. But you know what? No big deal. We're still here being able to give you some major information that you, the consumer, you, the buyer, you, the homeowner, and you wanting to be that financial responsible, steward of your money, give you those tips that you need. So my colleague Damien, how have you been, my friend? How's the week treating you?
I've been good. Been busy. But Christmas is upon us once more, so it's that time of year. So it's been nice, man. But yeah, how about you, man?
Hey, everything is going peachy. I love it. Get to spend much needed time with family, and I know that's what Tara's doing right now. So we love that. We have that capability of doing that in this new virtual world that we're in, and you know what? It's amazing. We feel, I know I feel extremely blessed. So now let's go ahead and give you a quick little market update. As we do pay attention to the market daily, and sometimes even hourly, just because it does change that often. We here want to make sure that you guys have all the vital information that you need. We've been noticing that rates, they're actually on a little bit of a decline, even though, hey, on December 18th, next Wednesday, Jerome Powell's going to do another rate cut, which is amazing. Even though rates are going down, we s- we saw some odd things happen, but hey, you know what? When the rates are on a decrease, that's always a good thing for you, the consumer, you, the homeowner, you, the potential buyer, where you're able to say, hey, this is a good note, and right now, want to be able to show you what that looks like, and again, you're going to hear me say it over and over and over. If you can afford the home, get it. Don't you marry the house, you make memories in the house. You don't marry the rate. You don't make the memories with the rate. All that information is with the home. So, as you can see my graph here, I'm looking at the purple right here, the FHA 30-year average closing for yesterday was 6.323, and that was the average of all the homes that were closed yesterday. Now you can see this forest screen here. This is if you have a little bit more of a top tier credit, 720 to 739 credit, and you know not as great as a FHA, but again, at FHA you have that upfront MIP, upfront mortgage insurance premium that you have to pay for, as well as monthly mortgage insurance, which, no big deal. We have ways to be able to navigate the best strategy for those going forward if you reach out to us here at Loan and Key. But you can see, if you do not have that top tier credit, a 680 to 699, you're looking at the average closing. It was pretty darn high at a 6.956, which is basically, almost 7% interest rate, that.
Seven.
And it's like, I know it's the time of the season to spend and use your credit card, but try to make sure you make those payments on time. As I alluded to last week, when they cut the rate, you're going to see that your new balance have gone up. Those creditors are going to say, hey, we have more money to lend out, so that means you get to have more money in your credit limit. Your minimal down payment or your minimal monthly payment has gone down, but when you're spending more, it's not really going down. You're just paying, you have a larger pool of money that you have access to. So with that being said, you know what? Reach out to us here at Loan and Key if you want to strategize the best possible outcome for your mortgage, your refinance. We are here to talk to you. All of our information will be linked down below, and even our webpage, which I highly suggest you guys take a look at it. You know what? We've been doing some work on it, and it looks amazing. So I highly suggest each and every one of you, yes, Damien, brush those shoulders off, because hey, we have been putting in that hard work. And if I'm not mistaken, it's like, I know Tara's in there, wordsmithing away with all of the information, as well as making sure all of our I's are dotted and T's are crossed. But again, we're here to make sure that you guys have the best strategy going forward for what you're going to be getting into. So we want to make sure that you have all of that. With that being said, I'm going to give you my little mortgage 101 tip, and then we're going to be able to give Damien his financial guru tip of the day, which, guys, pay attention because it's huge. He's going to give you some information that It's almost, I would have to say it's inside information. So, keep that ear peeled. This is why we're holding it towards the last and why we typically hold it towards the last. Exactly. So, what I'm primarily going to be talking about today is after the underwriting department has given the final approval, what's next? Most people think, oh, I get the keys. Yes, you do get the keys, but once they have given that final approval, it goes to the funding department. Okay. And the funding department ensures the completeness of all the mortgage documents. So everything that the process, or I should start over, everything that the loan officer did, everything's good. Everything that the processor did, good. And you guessed it, everything with the underwriters, good. Because there is a certain piece of information that they make sure they have, and that's all those boxes checked, because that's going to affect what's happening in the secondary department. Which, pay attention to our YouTube short videos, because I have a great video in there that's going to be posted a little bit later on after this one about what's happening in that secondary department. But what they do is they make sure all the clients have turned in all the documents that are updated. Loan officer signed what they needed to sign to make sure that there's no compliance issues, because compliance is huge. We want to make sure we do right by you, because at the end of the day, you're who we servicing. It's like I'm not going to go there, but I am going to say this. If you're not a good servant to the people you serve, what good are you? And I'm just, when you read my bio, you'll understand why I say that. So, anyways, so they review the employment and income verifications, because they want to make sure, hey, you know what, did the underwriter, did they just not push it through because they didn't want to do their job, and on down the totem pole? They're wanting to make sure that those checks and balances are there for your safety, for you, the buyer, you, the homeowner, the refinancer. Your safety is most importantly, and you know what, your safety in your wallet book, that's huge. And that's what they're trying to make sure. And you know what? Before they even tell the title agency, yeah, make the appointment to have this loan funded on this day. So the court clerk and yada, yada, yada. We'll go into that a little bit later. As you can see, there's tons of mortgage information in here that I want to divulge, but we want to try to keep these videos obtainable. So, anyways, once all that gets through, they coordinate the funding department with the title agency and making sure, hey, you know what, here's a time, date, and who's going to be at that signing. And then, hey, you get the keys to the home. You get to be able to say, you know what, whatever, if it's a refinance, hey, now I have that money to go pay off my student loans. Hey, I have that money to pay off whatever I need to. So, and again, reach out to us here at Loan and Key so we can make sure that you are handling that purchase or that refinance responsibly, because that's our biggest goal, is making sure there's knowledgeable buyers out there. And you know what, I'm even gonna say this, Damien. Even if you don't use us and you just closed, reach out to us. We will be able to say, hey, this is what could have been done differently. Or even if you did go with another lender and they did everything, you're going to hear bravo. You know what?
Yep.
And hopefully, wherever they didn't give you a little bit more information, we'll be able to add to it. And again, it's not going to hurt our. It's no sweat off me. I love talking mortgages. My wife, it's want with her. I'm glad I have Damien. He's here
Yeah.
to talk to me mortgages. But with that being said, I'll yield it over. And Damien, now that big hidden secret, let's have it.
Yeah. No. Hi, everybody. So today we're going to talk about bonds. I know, real exciting, right? But it's actually something extremely important. And on average, as people do acquire a portfolio, any kind of retirement planning that usually goes into it, your portfolio will usually be a mix of two major things. It'll be stocks and it'll be bonds. The stock essentially is ownership in a company. When people say they bought a stock of Apple or Google or Nvidia or any of the companies that are currently on the Dow Jones Industrial Average, they have ownership. Bonds is something completely different. Bonds are, you are buying equity. You are buying equity to be paid back to you at a certain percentage. So if you say you bought bonds at 3%, then you're going to be paid back on whatever amount you invested in 3% of that return. So it's normally, if you think about it on like kind of like if you're looking at an algebra problem, or if we're looking at an XY axis, a bond is a line that kind of just goes straight. It goes straight, doesn't really have much of an incline or a decline, just kind of goes straight because it's always getting paid at the same rate. It's the same debt that you bought to pay you back at that rate. That's where a bond is different. It's not ownership. A bond is not ownership. A bond is an agreement to be paid back that you're buying debt. And so the traditional definition of a bond is essentially this: bonds are loans. Bonds are loans from you to a company or government. There's no equity involved, nor any shares to buy. Put simply, a company or government is in debt to you when you buy a bond, and it will pay you interest on the loan for a set period, after which it will pay back the total amount that you purchased the bond for. And then usually there's a little bit of extra in return for it coming to maturity. When they say that phrase, holding until maturity, that means that you've held it until all of the length of time that you agreed to purchase the bond for, and then it should have paid you back at whatever said interest rate that you had agreed upon. So people will hold bonds in their portfolios for the main reason. The two terms that you will always hear on the stock market: a bear market, that's when the market is doing poorly. That is when stock indices and performance are all on what? A decline. There is degradation completely taking place. Now, when there's a bull market, it's the absolute opposite. And yeah, right. We are in a bull market right now. I know. I love that face that you make. So a bull market, all of your indices and all of your lines and all of your slopes will basically be heading in an incline. Everything will be going up because performance is going up, equity is going up, performance is going up, etc. So you have bonds though, because bonds are always going to be that offset to the curvatures of bull markets and bear markets. But there's always this set of bonds to pay at a rate. It's mainly just to reduce volatility. That's the main purpose of why bonds are held in portfolios. The traditional old school portfolio used to be 60% stocks, 40% bonds. A lot of that's starting to change these days just because of how amazing stock performances have been, especially over the past several decades, especially the United States stock market. But not only to add to that, it's the fact that bonds are not having the rate of return. And that's where
Mm.
more and more where people are starting to hold smaller percentages of bonds and larger percentages of stocks. That's been a trend. There's also been another trend of where people are actually staying in mid-aggressive and aggressive segments of stocks for in their 50s, some people in their 60s. So it's very, whereas we were told 20 years ago, as soon as you start to hit in your 50s, you need to convert all of your portfolio to something conservative. It needs to probably be really heavy on bonds, hence why we're talking about it right now. But it's not always the case. But we do need to cover bonds because it's an important part of anybody's portfolio as you do begin to prepare your nest egg as we get older and we get prepared for retirement. And bonds are an essential part, but that's essentially their function. It's not the sexiest of topics out there, but it is really important to understand that it's one of the things that's in your nest egg to help reduce volatility. So that's the secret. But honestly, though, that's your definition, though, and it's to give you an idea of what bonds are. It's not ownership. You're buying debt. They owe you that, and it's supposed to pay you at a said return. So with that said, that's our financial guru tip for the day. So I hope you learned something. I hope you did too, Robert. Um, so
Always. Always. No,
yeah,
thank you,
but
Damien. It's a huge burden to be able to, understand what that is. And you know what, my friend, this is why I feel blessed to have you as our financial guru, as our, financial strategist when it comes to this information, because you know what, as a mortgage professional, I've utilized your help when it came to this. And it's like Damien, you know all the mortgage knowledge I have. There's still financial knowledge I still need to acquire that it's always going to be an everlasting growth if you want to be able to be on top of your financial game.
Yeah, it never stops, man. It's I every day. I've still learned something, whether through Bloomberg, Wall Street Journal, just doing just normal, just research and just yeah, it's always continuous learning. So good stuff. But on that note, I think we're gonna go ahead and need to draw our episode to a close. Want to
Mhm.
thank everybody for watching. We always appreciate it. Remember, Loan and Key, please. We have
Information
all of
down
our
below.
information. So we always appreciate it. And with that said, I would just like to say thank you, Robert, for a superb market report. Thank you for our Mortgage 101 tip and just letting us know what happens in that final step, in that final process. Always good stuff. And I hope you guys did like the tip from your financial guru today. So we have more in store. Stay tuned. Loan and Key. We'll talk to you soon. This is the Financial Guru.
And your mortgage expert, Robert Talk, signing out.
Signing out.